Next guest says that the market is a yo-yo, stuck in a 4% trading range, and she still sees a smorgasbord of risks out there. For more on the markets, the Fed, the earnings season in general, so far, want to bring in Jackie Cavanaugh, portfolio manager at Putnam Investments. Good morning to you. 4% on the upside, 4% on the downside. That's what we're looking at?
That's certainly what we've been looking at for the past few months. Yeah, I mean, we've been stuck in this trading range. We've pierced through 4,100 6 times. We pierced down through 3,950 6 times. I mean, we're just looking for direction, and there's a lot of disconnects out there. You mentioned the smorgasbord of risks. I certainly was listening to your conversation with Senator Toomey. The debt ceiling does loom as a pending risk. The disconnect between when the market thinks the Fed's going to start cutting and when the Fed is saying they're going to start cutting certainly poses a risk, as well as earnings estimates, which we think still the back half of 23 earnings estimates are too high. I mean, for Q4, the market right now is anticipating 8.5% annual growth for Q4 earnings, and yet 3 cuts also in Q4. I mean, those two things just can't intellectually be consistent. And so we do still see a lot of risks. It's instead of go away in May, we should have gone away in January.
So, but the real question is, I think we're all looking for direction. Your sense, though, of that direction, if we have this conversation, call it Christmas time, 23, what does it look like?
We think the rest of the year is going to be very much what you've still seen. We still think that the disconnect between the Fed and the market has to close. We think it's unlikely to close to the market's benefit. We think the debt ceiling really poses a legitimate risk. This is one of the tougher setups we've seen. And I would just remind your viewers, if you go back to the debt ceiling debate in 2011, the market fell 18% in a month when we went through that. And it started from a multiple of 13.5 times forward earnings. We're at 19 times forward earnings. And so the setup is just weak. So we think it's going to be a lot of this push-pull until we get some real direction. You know, I'm hoping that maybe we'll get something from the Fed next week, but hope's not a strategy. And I think that they're really, again, in a tough spot. I would say, Andrew, though, here at Putnam, where we do fundamental research, it's a great time to be a stock picker. I mean, this type of up and down volatility gives you opportunities to buy great companies at a discount, which is what we do.
So, Jackie, tell us what you like.
So we really think that Schwab is very interesting here. That's a name that's gotten a lot of coverage on your air. You guys have talked to the CEO a number of times, which has been great. And we think that just was one of the stories that got thrown out the baby with the bathwater, where, you know, they have 86% of their deposits are insured. They have the most insured deposits of almost any bank in the country. They've got a very diverse deposit base and very conservative balance sheet. So while, yes, they've had some held to maturity marks, we think that's a franchise that is in terrific shape. They continue to take in assets throughout the entire duration of the SVB. Actually, asset growth accelerated post-SVB. So we really think that's a story that's been very misunderstood by the market.
Give us some other names.
So we like the big banks. We think the big banks are winners here. We particularly like some of the more value-oriented big banks, whether it be Citigroup or Bank of America. I think the challenge we're facing, and you mentioned, Andrew, it might be a long weekend with First Republic, is, you know, while this environment has been good for the bigs, and they've been relative winners if you think about deposits and cost of funding and scale, we do have concern that the regulatory reaction to what happened in SVB may be an overreaction. We certainly saw some of that coming out of the GFC. The big banks are in just great position from capital, credit, across the board. But, you know, if you have a regulatory overreaction to what happened, that can be a negative.
And the question on that front, to me, the question is whether you actually think, I don't know if it's going to be an overreaction or not, but whether you think the models of these banks ultimately have to change, both big banks and small banks, whether the lesson of, you know, $42 billion rushing out of a bank in 4 hours forces a sort of major shift in how these banks operate, how much capital they have to hold.
Yeah, I do think it will lead to some real soul searching on the part of both the regulators and the managers, because the speed of how SVB went down, you mentioned the $40 billion. It was $140 billion over 36 hours at the push of a button on a phone. That is unheard of. And so that is definitely a risk that I do not think is currently incorporated into either the regulatory framework or the risk management frameworks, frankly. So, yeah, I do think that has to change.
Finally, Jackie, what do you think of big tech? We saw Amazon. It delivered in a big way, but you know, then you have Microsoft on one side, you got Google. I don't know where you put Apple. We'll hear from them next week.
Yeah, so what we would say here is our view is on the big tech that you have to look at Meta and Microsoft a little bit as idiosyncratic, right? It was very stock-specific wins. Asia's having really good results on the cloud, but broadly speaking, you're seeing a broad slowdown. Now, what we do see as a positive is, January, the rally was really led by lower quality beta. Post SVB, you've had some rotation where big tech is really working and is helping to lead the market. But we think some of the wins you've seen in tech thus far have been very company specific, but the broad backdrop still remains challenging.